Student loan garnishments are coming back. That means millions of Americans could see up to 15% of their paycheck snatched before it ever hits their bank account. To pay a debt they can't wipe out in bankruptcy like almost every other kind of debt. I'm Jeff Kelly, a consumer bankruptcy attorney in North Georgia. This is general bankruptcy information, not legal advice. Details vary by case. If you need help, call my office at 678-820-3680. In a Wall Street Journal article published January 5th, 2026, the Education Department announced it's restarting wage garnishments on defaulted federal student loans. Over 3 million borrowers are going to start getting notices. For many families, that's rent money, that's groceries, that's gas to get to work. Now, here's the part that doesn't make sense. If these same people were drowning in credit cards, medical bills, or even old repossession debt, bankruptcy would give them a fresh start. But because it's student loans, the rules are completely different. Under today's law, most student loans are presumed to survive bankruptcy, unless you can prove undue hardship, a very high bar. How did we get here? Before 1976, student loans were dischargeable like other debt. In 1976, Congress limited discharge during the first 5 years. By 1998, the time limit was removed. Federal loans were non-dischargeable at any time. In 2005, protections extended to most private loans. Congress turned student loans into a super debt, harder to escape than almost anything else. Meanwhile, the price of college shot through the roof. At public four-year colleges, tuition rose about 220% above inflation since the 1970s. Americans now owe about $1.6 trillion. The average federal balance is roughly $38,000. Costs skyrocketed as bankruptcy protection was stripped away. Let's walk through the logic. Reason number one, almost zero risk for lenders. They can garnish wages, intercept tax refunds, even take Social Security. So what do lenders do when risk goes down? They lend more to more people with less caution. Reason number two, colleges can raise prices because the money is guaranteed. If any 18-year-old can borrow thousands, colleges know the money will be there. That encourages higher prices and fancy amenities. Ever wonder why every college feels like a resort now? It wasn't that way in the early 90s. Reason number three, borrowers carry all the downside: illness, divorce, job loss. If your business fails, debts can be discharged. But with student loans, the message is, no matter what happens, you're stuck. That's not a fresh start. That's a lifetime sentence. Reason number four, it hurts the broader economy. People delay buying homes, starting families, starting businesses. It drags down everything else. I'm arguing for simple fairness. Student loans should be dischargeable in bankruptcy the same way other unsecured debts are. This would restore a real safety valve. Bankruptcy has protections like means testing. Letting student loans be discharged gives honest borrowers a way out. It would force lenders and schools to share the risk. Lenders would underwrite carefully. Schools would think twice before jacking up tuition. Right now, the message is backwards. Max out a credit card on junk, wipe it out. Borrow for education, you're stuck for life. Why this matters right now? Every House seat is on the ballot in November 2026. Campaigns are starting now. This is when issues get locked in. Ask every candidate for Congress where they stand on making student loans dischargeable. Ask them at town halls. Reply to their emails. Talk to your friends and family. Keep the focus on policy. The future belongs to those who show up, take action. If you're in Georgia and buried in debt, we can walk you through what bankruptcy can do for you. Call the law office of Jeffrey B. Kelly at 678-820-3680. Student loans shouldn't be untouchable while families get crushed. Bankruptcy is a second chance. It's time for student loan borrowers to have that fresh start.